So a little bit about me. Pointers Financial is about 18 months old. I've been an advisor for around about 8 years, but we offer local, completely independent, so we can look at all the different lenders for you. But most importantly, our advice is free. So one thing I always like to remind people is that the way that mortgage advisors work is we all get paid a commission from whichever lender we introduce you to, and that could be anybody from the high street lenders that you've heard of loads, so people like Barclays or NatWest, to some of our more obscure lenders. So in the buy-to-let world, that can be people like Fleet Mortgages or people like Shawbrook Bank, that type of thing. And they all pay us a fee that varies slightly depending on what you borrow. And some mortgage brokers charge fees in addition to that, which you may already know, but we most importantly don't charge anything at all. We just take the commission from the lender and that's all. So the only other fees you might encounter are things like arrangement and valuation fees, but I'll talk about that a bit later. So yeah, that's me. Prior to that, I worked in a estate agency, funnily enough, with Emma some years ago now. And so yeah, I've kind of branched into this now, but yeah, we operate, we're a fairly small team, there's 3 of us, and we're based sort of across South and East Devon. We mostly work from home, but we do face-to-face appointments as well, if that's your preference. But that's sort of the initial part about us and how we work. So the basic questions I sort of find myself asked a lot is the deposit kind of size when you're talking about buy-to-lets. So generally speaking, the rule of thumb is in an ideal world, you want to be with a 25% deposit. That's kind of utopia for buy-to-let lenders. They want you to have the 25%. You'll get a fairly competitive rate. It's still the upper end, but rate-wise, it's looking to look fairly competitive. And that means that it's kind of the benchmark for some lenders. Some lenders, that's the only thing they can do is 25%. Now, you can branch into just having 20, but generally, with most properties, certainly in this neck of the woods in the Devon area, but obviously it varies around the country depending on where you buy. And that means that you can have a 20% deposit, but quite often that means the figures then don't quite stack up in terms of the rental figure that you're going to get for the property versus the 20% deposit you're putting in. And like I say, less lenders will just offer that. So you might find there's a niche range of mortgage rates, typically. The other option is, when we're talking about deposits, is where's your deposit going to come from? So generally, most people have either cash in the bank that they've saved up, they've inherited, they've acquired through one source or another. Alternatively, one thing that we do talk about quite a lot is what we call a let to buy scenario. And that's where the house that you live in, typically, you might have enough equity into remortgage to release some of that money to then go and buy a buy-to-let property with. So that is an option to consider. It doesn't work for everybody. Generally, the rule with that is the property you're buying as an investment has to be of a lower value than the one that you currently live in, just to make sure from a lender's perspective, risk-wise, that's where they're making sure that you're actually, you are definitely buying it as an investment property, you're not going to live in it, or, family living in it or something like that. But one thing to remember is we always need evidence of this deposit. So be that a bank statement just with your cash in it, or a mortgage offer from what we're remortgaging for you, or if you're selling something, perhaps. Sometimes you get clients that downsize. If you're selling a property and then your downsize, realise some of that money. So it could be things like the memorandum of sale from the estate agent. Sometimes a lender might ask for that if that's a scenario. But it's very important, as your solicitor will also confirm with you, that there's proof of that available. And in terms of things like fees, obviously making sure that you've not only got that 20 or 25% deposit, but you've got things like the stamp duty paid, your solicitor's bill. Sometimes there could be other costs involved depending on what you want to do with the property, which I'm sure you've talked through in previous webinars. So things like gas safety checks that you might need to do to let the property out. Also things like looking at additional stamp duty. That's obviously more than if you were buying a house if you didn't already own one. So that's something to consider. But like I say, all the questions at the end, so I appreciate I'm talking quite a lot. So if you've got any questions at the end, then fire them away and we can answer them. So one massive question that I get asked a lot actually is, should we be taking this mortgage on an interest-only basis or a repayment basis? And it really, really varies. And the biggest question that I ask at this point is, why are you buying this house? Is it for you? Long term, are you buying it to rent out now, but you might want to live in it in your later years because it's in a nice area or it's a bit smaller? Or, are you just doing this because you want, investment month by month and you want a return on your capital? And depending on that answer is where we end up with this, really. So if you literally just want the month by month return, ultimately the reason to have a full repayment mortgage is because at some point you want to completely own that property. So if you're somebody that's retired and you're just doing this to boost your pension, you're just doing that for the monthly income in the same way that a pension might pay you the monthly income. So whether or not you own it in 20, 30 years time isn't always hugely relevant. So that can be something to consider. But if it's something that you think, yeah, I really like this property and I want, say, my family to inherit it, then repayment could be an option for you. And it's just about making sure that mostly this is really tax efficient for you. And one of the things we have to do as mortgage advisors, and also just from a moral perspective really, is to make sure that you have had suitable tax advice, because it's really, really important to make sure that you are doing this for the right reasons, and you're also doing it in the most tax efficient way. Because there are things to consider, things like whether or not, if you're a couple, for example, whether or not the purchase is done in joint names or one name, because then if one person's a higher rate taxpayer and one person's a basic or nil rate taxpayer, then they might find that there's perks to having it in just one name, depending on the income that you're looking to draw. But obviously accountants will talk you through all of that and advise you in the best possible way. And the reason I put protection up there is because some of my landlord clients, they like to do things like life insurance, which is something we look at as part and parcel for most of our clients. But generally, it's when you worry about your own home in that kind of scenario. If something were to happen to me, I want my family to be in my home, that type of thing. But a lot of clients do like to look at it for their investment properties, because ultimately, when they buy that property, they think, okay, this is great, and I found this great property and it's a really, really good investment. If something happens to me, I want that investment to still be available to my family. So even if there's a mortgage outstanding, if they can insure against that and make sure there's a lump sum payout to mean that that property could be owned long term, especially if it's a property that they've maybe bought thinking, okay, this is a great investment now and we're just renting it on a standard assured short hold tenancy and we've just got a family in there, but in 20 years it's in a lovely nice sunny part of Dawlish or something, and you think, well, actually I might want to live here, then that's a really, really good scenario to think, well, actually I want some life insurance here. So I guess the key point I'm making here is that it's not just always about the mortgage, it's always about looking at everything from a rounded perspective. From us, we have to tick box to make sure that you've had some tax advice, and also to make sure that you're looking at the future of this investment. So that's something really to consider. So the key reason, obviously, for the subject matter of this webinar is, should you fix? And this is a question I am asked probably about 80 times a week from several different people, even people that have already got a mortgage and we're not looking to do anything now. It's just a massive topic of conversation. So the biggest point of this is to always talk this through with your advisor. Part of our job is to make sure that we've had a lengthy discussion with all of our clients as to the reasons why we should and shouldn't always have a fixed rate, a tracker rate, something more variable, something more flexible, and whatever it is. And if you aren't having that conversation, I strongly encourage that you do, because at the end of the day, everybody's in their own profession for a reason, which is why I was saying, you need to go and see an accountant to get tax advice. You come to us to talk about what rate would suit your personal circumstance best. Because if you do a fixed rate, what you don't want to do is do a 5-year fixed rate and then in 2 years say, well, I want to sell this now, and realize that entire mortgage, because your early repayment charge on a fixed rate is going to be quite substantial potentially. And when you're talking about investment properties, you want to maximize every penny of return humanly possible. So we don't want to be wasting money like that. So that's something to consider. If you do decide that a fixed rate is for you, then it's just a case of how long. So, of course, there are two key types of mortgage rates. You've got fixed ones and variable ones. The fixed ones are typically fixed for periods of 2, 5, 7 or 10 years, with 2 and 5 years being the most common, in that pretty much every lender offers that in some shape or form. However, some people do like to fix for longer, although 10 years is always quite a long time. We are seeing it more and more now with rates rising, but it is a really, really long time. to be stuck in that. And the early repayment charges with these will vary. So that's the downside of a fixed rate, basically. If you were to exit that at any earlier period, then you've got a payment to pay to redeem that mortgage in full. So typically you've got a period of the fixed rate, and it can vary from sometimes up to even 5% of what you owe, right down to 1%. Some are on sliding scales. Some are fixed, say at 3% for the entire fixed rate. So it's just about, whatever works best for you, really. And one key question in that as well is a renovation. So if you're renovating a property, if you're buying something that needs a bit of attention and you think, okay, I'm going to do this, rent it out, or, see how it rents out, and, it doesn't quite work out for whatever reason, then, you might want a bit more flexibility. So looking at something like a tracker rate where there's no early repayment charge could be beneficial. And it's not always that, I've had clients in the past where they've bought a property as an investment and thought this is fantastic, it's great. And for whatever reason, one, they've just had a stint of bad tenants, which unfortunately does happen, and it can put people off, and they say, I want to sell this now. And alternatively, it can just be that you've had a change in personal circumstances where you think, actually, I don't want to be a landlord anymore. There's too much admin. There's too much going on in my life. So, sometimes you can't always plan for these unforeseen circumstances, but, the fixed rate themselves, you've got to think about that kind of option. And also this relates into how liquid or illiquid your buy-to-let property is. So if it's in a really popular area and you think that's fine, I could sell it really, really quickly, or actually it's something that's a bit of an acquired taste, it was sat on the market for 2 years and I got a really good deal, then you might think, okay, a fixed rate could be an option because I'm going to keep it for a long time. Or if you're looking at growing your property portfolio and you're looking at remortgaging every couple of years, if that property's gone up in value just by the nature of the market, or if you've done things to it or whatever it might be, and you're looking to either release money from a remortgage, or you're looking to sell the property to upgrade in some way or another, then a fixed rate, could work for you. But then it's about thinking, is that a 2-year plan? Is that a 5-year plan? And it's also looking about the difference of these as well. So typically a 2-year fixed rate is cheaper than a 5-year fixed rate, with the idea being that at the end of the 2 years, it might actually cost you more anyway. And a lot of these come with a lot of fees as well. So there's a typical rate at the moment. It's 3.94% fixed for 5 years, but it comes with a product fee of £995. Now, typically product fees you can add to the mortgage. You don't need to pay them up front, which is good from an investment perspective. But what you don't want to do is every 2 years keep adding that £1,000 to your mortgage, especially if you are looking at interest only, because if the value stagnates or the value doesn't increase by sufficient margin, that 25% equity you've got will slowly start to dwindle. And if you're doing that every 2 years, it can really erode the return and the yield that you're getting. So, that's always worth considering. Equally, there are products with no fees as well. So it depends upon, what order they look in. But generally, when we look at interest rates for mortgages, there's 2 ways we look. You can look at just the cheapest interest rate, which is what you'll see online, and they don't do it so much now, but you used to see them in posters in bank windows and things like that. And that would then say, yeah, we've got this great headline rate. Say it was at the moment, a good rate at that would be about 3.4%. But then you look at it and think, well, actually 3.4, oh, hang on, there's a £2,000 fee. So that's not quite as competitive. So what we tend to do is look at what's physically going to cost you the least over a 2, a 5, a 7, a 10-year period, and make sure that works for you. But there's loads and loads of different reasons to go to different lenders with buy-to-lets. So lots of lenders have, as a lot of you may be familiar with, a minimum income of £25,000, and you can't get away from that. It's a tick box. A lot of lenders have actually reverted on that in recent years, and some of them, NatWest, for example, or Called Mortgages, which Yorkshire Building Society, have taken that requirement away completely, but lots of lenders still have it. So if your income is less than 25, then quite often then we're left with a slimmer pool of lenders, shall we say, but not massively. And it's about looking at, when you're talking about fixed rates, you know, like we said, who's going to be in the best order and cost you the least, but there could be another reason that you're looking at something else. So is it a property? Is it a flat with a short lease? Is it an ex-council property? You know, all these different things that can come into it. So it's really, really important that you talk all of this through with your advisor and make sure that you're looking for the right rate for you personally. So which is backtracks to what I said at the start, really, that all of this is such a personal scenario. No one client is the same as another one in our world. They are all different and doing completely different things for completely different reasons. So one question we get asked a lot at the moment is becoming sort of more popular, is should I buy through a limited company? Which you may have spoken about in previous webinars from a solicitor's or an accountant's perspective. Generally, it's accountants that pay, you know, attention to this. And again, as I said in the last slide, it's all about reverting you back to those accountants and getting that professional tax advice as to whether this is the right option for you, because it depends on your personal circumstances very much, as well as your long-term plans. So from a lending perspective, there are a number of SIC codes that you have to apply when you set up the limited company, if you do so, because SIC codes themselves, you couldn't have a company that, say, you'd set up that you run a cafe, but you've actually now decided to buy a property through this company. It doesn't work like that. It has to be a company that's set up purely, a special purpose vehicle set up purely for the purchase of property or letting of property. And most lenders have a limited pool of SIC codes that you can apply on company's house. There are companies that will set this up for you, and I have had clients use them in the past. Obviously, it comes at a cost. So again, it just comes down to what works for you and whether or not your accountant, you know, comes back to that. You know, and as to whether that's a suitable thing for you to be doing. Limited company lending, there are less lenders that offer it, basically. There's not a great deal of high street lenders that will look at it. So generally in this scenario, you will be looking at niche lenders, even quite often people that a lot of people haven't heard of, and they go, oh, you know, who's that? But they're just more specialist because it is a more specialist field in its own right. So, and quite often some of these rates can carry higher product fees. So where I gave that example about a 995 product fee, a lot of these can typically be in percentage terms. So it's things like, it might be say 1% of whatever you're borrowing, which again, you can typically add to the loan, but it's all about, are you eroding that investment with that deposit and what's going to happen in 2 or 5 years, thinking about the market, thinking about where the property is going, particularly if you're looking to switch lender. So in, say, 2 or 5 years' time, you might want to remortgage, just shopping around. Works a bit like car insurance. So we just basically look at your existing lender and see what they're offering. And if that's not too competitive, we'll move you. And quite often we can get you things like free legal fees and things like that. But with limited companies, most rates don't come with free legal fees. So obviously the solicitor does need to do a bit of work when you look to remortgage. And with limited companies, it's just a bit more lengthy. So lenders don't typically offer that for free. Things like valuation. So obviously when you do a mortgage, you've got to have a valuation done on behalf of the lender. It doesn't really tell you anything. It's quite often referred to as a survey, but it's not really commenting on its condition or anything from your benefit. All it's doing is they're agreeing, checking that they agree with the price you're paying, which in this market, we have seen some come back at lower, and then there's been a bit of renegotiation or more cash required, that type of thing. But it generally means that, you know, limited companies, because they're all more expensive, it can kind of erode at your investment a little bit. But again, it depends on your long-term plans, really, you know, as to whether or not that's something that's suitable for you. And again, it's all about referring back to that accountant, back to that tax advice and making sure it's right. But we're happy to work with these guys. You know, quite often I'll have clients come to me and say, my accountant said this, but can I just talk through rates with you first before I say, yeah, I definitely want to do that through a limited company, or whether or not I do it personally, because there's a lot of implications, and it's a very different form of application as a mortgage advisor. Typically, limited company applications, as much as it's the company that's buying it, it still has what we call personal guarantees. So you personally will still be assessed in terms of like your income, your credit score and things like that. It's not just the company. And that's just purely the lender checking it out from a risk perspective. They want to make sure that they're getting their, you know, fair share, as it were. You know, they're not being, you know, people aren't taking out mortgages that aren't financially viable, or, you know, have had issues in the past, credit wise, that type of thing. That's kind of all that I had to run through initially. So it's just to see if you guys had any questions at all.
I also, any questions go in the chat box, so I'll just put down there. So you can all type away and I will read out questions to Mercedes so we can try and get through as many as possible. Let's just stop that and then we'll be next to each other. So I had a few on email, Sadie. So while people are typing, I will ask you the first one I had. The first one I had through email, what is the current Bank of England base rate and why does it keep rising?
That is a very, very good question. So why does it keep rising? So generally, it's economically speaking, the interest rates have increased to combat inflation. And therefore, because inflation is so high at the moment, as you'll see from the news, everyone's moaning that the gas bill is going up and the shopping is going up and everything like that. So because of that, the Bank of England have made the decision to obviously increase interest rates, which to be fair is happening globally. I think the only country that's not doing it is Turkey, strangely. So that's kind of why they're creeping up, which obviously is affecting fixed rate lending. Now, fixed rate lending is generally agreed in tranches that are typically 2 years in advance for some lenders. But because the inflation has been creeping up for a while and lenders know this is coming, we have seen an increase in rises. So the lenders are sort of preempting what's happening, which is fairly typical. Historically, the same things happened. So you might find that even 6 months ago, we were getting rates at sort of early 2% on a buy-to-let, whereas now, as I was saying, that's late 3%, and that's within a 6-month period typically. But the Bank of England base rate, it was raised last week, it's now 1.75, which is actually the largest single jump in 27 years.
Right. Lovely. So Carol's asked, it's sort of going on that theme, what do you recommend for increasing interest rates? And I suppose it's, as a landlord, how do you recommend sort of combating that? So
obviously, where interest rates are going up, that's because inflation is inflation is happening. So rightfully speaking, your tenants would probably expect at some point you're going to put your rent up. It doesn't necessarily have to be drastic, but ultimately costs feed through. So, I've had a lot of clients that have been putting rents up, where I was talking about valuations earlier. So when you do a buy to let, it's not only checking that, say you've agreed to buy a house at 250,000, it's also checking that, yes, it will rent out for the £900 a month that we've said. So where you're talking about increasing the rent, those valuations we've been seeing, as much as the house price have been going up, obviously rents have been going up as well. So I think most tenants would be understanding of the fact that rents are going up. So that's one way to look at it. The other thing to consider is your timing. So a lot of lenders now will let you look at a product transfer. So that's a rate switch when you're coming to the end of your fixed rate or whatever rate you've got. And that is worth looking at up to 6 months in advance now. We're getting clients come to us earlier and earlier because they're seeing rates creeping up. So it's about managing your portfolio and keeping on top of those and thinking, okay, that rate's going to end then. I need to contact my advisor now and secure something, get an application in if we're remortgaging for you. Because all that happens is it kind of just sits there and we wait until it goes through. But because mortgage offers last that period of time, we can secure those and lock those in now. I mean, hopefully if you use an advisor such as us, we write to all of our clients anyway to say your rate's ending soon, do you want to look at something, and what are you looking to do, and then we can advise them accordingly.
I think that goes on to Amanda's question, which actually came in while she was speaking then. Is an early redemption and fix a good idea now? Is an early redemption and fix a good idea to secure a rate now rather than later? And that's basically what you've just referred to, isn't it?
Yeah, so again, it's really dependent on the individual circumstances of the client, but you might find that fixing into a rate is good. But generally, I have had some clients ask me in the past couple of weeks, I'm in this fixed rate, it's only got a year left, I want to fix in for like a 7-year type thing, should I pay my early repayment charge? When you stack it all up, because early repayment charges are typically quite high, unless you owe a very small amount, to justify paying that, it's not usually viable, but it's definitely worth checking.
Yeah, lovely. We've got another question in here. Could you tell me a bit about second charge mortgages? We need to release some cash from current property. Is there a way to do it?
So generally you would only look at a second charge if a standard remortgage to release funds wasn't possible for whatever reason. Second charges are a lot more expensive. They're more of a niche lending zone, if you like. So yeah, it's something we can look at. It's more of a specialized market. And we do them, but like I say, we would usually exhaust avenues of all different lenders and things to establish if we can get anything out prior to that.
Okay, that leads on to a question that came in. Where have I? So I have a buy-to-let property which is now worth 100,000 more than what I paid for it. I only took out a small mortgage to the purchase, so I have a lot of equity in the property. Can I take the equity out to buy another buy-to-let? And if so, how would it work and how would I do it?
So it depends on everything, what the property rents out for and everything like that. But yes, if you have got substantial equity, it's definitely worth checking. And all you need to do is work out kind of roughly what sort of price you want to buy another property at. And then the easiest thing is pick up your phone to us or your advisor and talk through the figures and see what feasibly you could release from that particular property. Because it all depends on the rent the property is, whether or not you're in a fixed rate as well, because additional lending in a fixed rate would trigger your early repayment charge if we had to go to a different lender, but we can get what we call further advance from your existing lender, and then at that point that's where you're in a position where you don't have to pay your early repayment charge, but you could still get that money, but you are then tied to that lender's rates. So
not as simple as it gets made out to be sometimes.
Unfortunately not. No,
I just know
lovely
a lot of
landlords.
Exactly. So, a lot of landlords with us that are saying, obviously, my properties are worth X amount more in the current market. Can I release some equity and buy another buy to let? That's why I think that question is coming up quite a lot at the moment. But the media seems to make it out to be quite an easy, straightforward thing to do. Well, yeah, just take some money out and use that as your deposit. And that's not the case, is it?
Because as I was saying earlier, it's not always just about the deposit, it's about the fees. 3% stamp duty bill could be quite a sizable chunk to have to pay. And if you don't necessarily have those funds available, or it's quite tight figures to release money, and that's where it's about just working out if it's feasible or if it's a good idea. We have done some for clients where they've really utilized that equity that they've gained in the last few years because the property prices have risen so considerably. But then I've had some clients come to me and then think about it and go back and then say, actually, I'm not so keen on that. I feel a bit at risk because I've really mortgaged everything to the hilt and I don't want to do anymore.
Yeah, exactly. Perfect. Any other questions, please type them in, otherwise I'm going back to my email list. So another one that came in: if we do go into recession, which we know has been sort of spoken about in the media recently, will interest rates rise or fall, typically, looking into your crystal ball?
Oh, if I had a crystal ball, I'd be a millionaire. So essentially, if we go into recession, it's really difficult because historically there's been quite a few different things. If you look back to the 70s, or if you look back to like 2009, so 2009, obviously property prices hit an all-time low, well, not an all-time low, but the lowest in recent years, and it took a while for the economy to recover. The problem we've got here is the inflation at the moment is just particularly rife. So all the time that historical economic behaviour tells us that increasing interest rates will slow people's spending and therefore stop the price rises, that's going to keep happening. However, recession generally to the average person's kind of thinking is, oh, recession, that's really scary. Let's not spend any money. Let's not go on holiday. Let's not buy a house. Let's not do anything. So then that really grinds the economy to an even bigger halt. And then that's when inflation, in theory, will really, really slow and get back to kind of standard levels. I think the model's 4%. Once it's kind of back around then they'll go, okay, we want people to start spending money now because the economy is in such a state. We need a big boost. And that's when they'll then start saying, okay, let's cut rates. And it puts people in a better position. So yeah, it's very, very difficult to tell. If we do, it's not going to be instantly, would be my opinion. But
yeah. Okay, but recession potentially might help interest rates come down in the future?
In the future, in theory, historically, yes, but it's not a short game.
No.
But property investment never is. It's always about the long term, and that's what.
No, exactly. So I've got the last one I've got here. So if anybody else has got any other questions, please do write them in. I'm relocating for work, but want to keep my current property, rent it out, and I need to buy new property in the new location. I've heard of let to buy mortgages. How do these work?
Yeah, so they work very similar to just buying a normal buy-to-let. It's kind of really similar in that you've got your house, you remortgage to release some money to use as a deposit to buy the new one, but you're converting your existing property into a buy-to-let mortgage. So it's kind of the reverse of what we were saying, where you remortgage your house to release some money to go and buy a buy-to-let. You're actually just doing it the other way around. So the only rules generally are that the property you're buying, the new one you're going to buy to live in, needs to be of a higher value than the one you're leaving behind to rent out, or very similar, we can argue sometimes, unless you're having a huge change of area. If you're having a huge change of area, and depending on your profession, then sometimes there are lenders that will consider that. But yeah, it's definitely, as long as you've got the equity there, that means that you're leaving around about 25% equity in the property as a buy-to-let, and then you've still got enough to go and buy an onward purchase. The minimum technically is 5% deposit you need to go and buy the new one, but in an ideal world you want to have more like 10 or 15 just to get you some more competitive rates. But when you're looking at different options, it's really important to just talk it through and work out what you're going to, what your long-term plans are for that, because you might find that it's what we call becoming an incidental landlord. So you're renting a property out, not because you went out to buy a buy-to-let, but because it just meant that you didn't have to sell your house and it just worked for you, which is good because you don't have a whole chain behind you and all of that type of thing, which a lot of people find beneficial. But some lenders view it differently. There's a few lenders that if you've ever lived in the house, it's because it's what we class as a consumer buy-to-let. If you've ever lived in the property, they won't look at it for a buy-to-let mortgage. There's only a few of them. I don't know why. They just don't like it. They think you're going to be too emotionally attached to it and spend too much money, probably. But it's not always a thing that's going to happen. So yeah, but let to buy mortgages are really common. We do a lot of them, and it's something that can really, really save a lot of aggro, particularly if you've got quite a niche property that you think you're not going to sell overnight. That can be nice. Or if you're in a bit of a hurry to buy, if you've got a new job in a different area and you think I've got to get out of here, I can't wait for an estate agent to come around and take photos and all this stuff, then and you found somewhere you want, it's a great thing to do. The biggest thing that we find that a lot of people don't know when they come to us initially with this theory is that they aren't aware of the additional stamp duty you need to pay. So the tax man, being the tax man, has to clobber you somewhere. And ordinarily, if you were just buying a buy-to-let, they'd just charge you the 3% additional stamp duty on the buy-to-let. What actually happens when you do a let to buy is, because they've got to charge you somewhere, they'll charge you that 3% on the new main residence that you're purchasing, which, as I say, is quite often a higher price. So that can become quite an expensive exercise. But it depends on how important it is to you to either secure that property you're doing, or be it for speed or whatever it might be.
Great. Just sort of on that basis, does rental value make a difference? Does it have to be a certain threshold that a rental value property would have to reach in order moving forward?
So that relates back to your individual tax rates. So, and that comes down to your personal income at the time. And every lender has what we call a stress test as to how much rental coverage it has to be. So it's quite a complicated calculation. But yeah, it does depend on your individual circumstances and your tax as to whether or not it stacks up. Because no lender's going to lend you 75% of a property's value on a really lovely apartment that's got all these lovely gold-plated walls and things like that, if it's only going to rent for the same as next door that's really plain and boring. They kind of, obviously rentals don't always account for these lovely views and things like that, as opposed to like the sales price, and the sale price could then be really high off the back of that. It's just about, and that's where obviously you guys can help, because you'll find people, a decent investment property, and that's the key thing I always say to my clients. You're looking at it as an investment. You don't want to go around there and say, I don't like the wallpaper, because we haven't got to live there. So so that's an important thing to remember. It's kind of sticking to the figures and your long-term plans. So
lovely. And Amanda's just asked on that subject, do you find it let to buy people do downsize rather than upsize as well? So I suppose that might be somebody, children may have left home and they're trying to buy something smaller but renting it out. Would that be an issue?
It comes down to value as opposed to actual size of the property. We get a lot of people changing areas. So therefore then there can be a change in price. So if they're moving from London and they're buying a house in Devon, then generally speaking, the properties are cheaper in Devon. So that kind of would be considered by lenders, depending on your profession and what your reason is for moving. The thing that lenders get cautious about is, if say you were doing that from London to Devon, and you have this huge, great 5-bedroom detached house in London, and then you're saying, well, I'm going to go and buy this nice swanky apartment in Dawlish for the sea view. They're going to go, yeah, not really sure you're actually buying that to live in. Is that just a holiday home, or that type of thing? And it's all about responsible lending, and that's what lenders have to assess at the end of the day. But yeah, majority of let to buy inquiries we get are either job relocations or upsizing, and they don't want the hassle of selling, or they can't sell.
Perfect. I think that's everybody's questions. You've been very whizzed through that, Mercedes. That was great.
Yeah,
thank you.
Apologies if I spoke too fast for anybody. And if you have any questions, please contact us at a later date. Myself and my team are happy to help and answer anything. So, am I taking on new clients? I've just seen. Yes, happily.
Yes. Definitely. So, I will be emailing out everybody tomorrow that's attending tonight with the recording and with Mercedes' contact details on it. So the answer to that is definitely yes. She would love to speak to you.
Yes, yeah. Even if it's not me personally, when Emma gives you our details, if you phone the office, myself, Nikki, Lauren will be happy to help you. So yeah, thank you very much.
Perfect. And I know Sadie's mentioned a lot about tax advice. Today the tax webinar is next Tuesday with Andrew Brown from Bishop Fleming. So if you haven't signed up for that one yet, I know a lot of you have signed up for these two together, both finance side. It is worth, and obviously he'll be talking about bits and pieces, I imagine, around mortgages as well on that side. And his advice, like Sadie said, always get your tax advice as well as your mortgage advice with your buy to let. So that one is available, and we'll put a link on the follow-up email to sign on for that webinar if you haven't already. But thank you very much, Mercedes.
Yes, thank you. No, thank you very much, and thank you for your kind words, everybody.
Perfect. We'll send up your contact details, so anybody needs any further advice from Mercedes and her team, we'll send all those contact details out tomorrow so that you can get in touch with her. That's brilliant. Everybody have a lovely evening and enjoy the sunshine.
Thank you very much.
Thanks. Bye.
Thank you very much.